Ever notice how some people just seem to have like a natural knack for money? And then there are others who, well, let's just say they struggle a bit more. It's kind of strange, right? Like you can be super smart, a total rock star in certain areas of life. But when it comes to like finances, it's a whole different ball game. I remember this friend from college. This guy aced like every organic chemistry exam. The ones that made everyone else like sweat bullets. We all thought, he's going to be a heart surgeon or something. Super sharp. But then after graduation, he got caught up in like this multi-level marketing scheme. Lost a ton of money, ended up back at his parents' place. It just goes to show you, right? Being smart doesn't automatically make you good with money. There's something else going on, right? Something deeper. And that's exactly what we're going to explore today. We're diving into Morgan Housel's The Psychology of Money. This book is just full of these aha moments, those insights that make you rethink everything you thought you knew about, like money and wealth. Housel argues that it's not always about, being the best investor, crunching numbers like some kind of machine. It's about understanding these hidden forces that really shape our financial choices. He kicks things off with this story about a tech genius. He knew this guy back in the day who made a killing, designing some key component for Wi-Fi routers. This guy was in his 20s and already had more money than he knew what to do with. But here's the thing. He always carried around these stacks of $100 bills, like seriously thick wads of cash. And he'd flash them around, bragging about his wealth, often while, let's just say, overserved. It was this strange mix of insecurity and, honestly, kind of childish behavior. Like he was trying to prove something, but it just came off as, well, kind of sad. And this story really highlights one of Housel's main points. Success in one area of life doesn't automatically translate to smart financial decisions. You can be a brilliant tech mind, but still make some pretty questionable choices with your money. Why is that? Well, Housel argues that our backgrounds, our experiences, the stories we tell ourselves about money, they all play a huge role in shaping our financial behaviors, often without us even realizing it, right? Think about it. Someone who grew up during a recession, seeing their parents struggle to make ends meet, they're going to have a very different view of risk and security compared to someone who, grew up in a wealthy, stable family. Their experiences shape their views on money, right? And that's something that traditional finance often overlooks. Housel uses this idea to explain some seemingly crazy financial behaviors, like why do people play the lottery, especially those who can least afford it? On the surface, it seems totally irrational, but from their perspective, it might actually make perfect sense. It's a shot at escaping their circumstances, a glimmer of hope, however slim. Housel doesn't judge these behaviors. He simply tries to understand the underlying motivations. He argues that we all create these narratives around money, often based on our personal experiences. And these narratives, they can be incredibly powerful. They shape our financial decisions. And here's something that really blew my mind. Did you know how new some of our financial systems actually are? Like the 401k, the backbone of retirement savings. For so many people, it didn't even exist until 1978. Crazy, right?
And the Roth IRA came even later, in 1998. It's like we're all figuring this stuff out as we go along, which makes it even more important to understand, the psychology behind our choices, because the rules of the game, they keep changing. Think about it. If you were born in the 1960s, you experienced that crazy inflation in your formative years. I mean, prices literally tripled. Gas lines, remember those? That experience, it's bound to shape how you view money, how you save, how you invest, compared to someone who grew up with, stable prices. Other point Housel makes, we tend to overemphasize the role of skill and genius in financial success. We love to celebrate the stories of billionaires, attributing their wealth to pure brilliance, right? But often there's a huge element of luck involved, being in the right place at the right time. Take Bill Gates, for example. Yeah, the guy was a visionary, no doubt, but he also happened to attend one of the only schools in the world at that time that had access to computers. That's pure luck, right? Being exposed to this cutting-edge technology at such a crucial time. Housel even asks this Nobel Prize-winning economist, Robert Shiller,
What he'd like to know about investing that we can't. And you know what Shiller says? He wants to know the exact role of luck in successful outcomes. Isn't that fascinating? Even the top economists recognize that we don't fully understand the role of chance. We tend to study these extreme examples of success or failure, trying to extract lessons and, replicate those strategies, but we often miss the role of randomness, right? The unpredictable nature of events. It's like sometimes you win, sometimes you lose, and it's not always about skill or intelligence. This doesn't mean we should dismiss skill altogether, of course. But recognizing the role of luck and risk, it helps us understand that things are never as good or as bad as they seem. It encourages humility, both in our own successes and when we're judging others. Sometimes this whole psychology of money thing, it gets a little dark. Housel tells this story about Rajat Gupta, former head of McKinsey. Super successful guy, respected business leader, serving on prestigious boards, earning millions. But then he gets caught up in this insider trading scheme, making millions more through these illegal tips.
He ends up in prison, losing his reputation, his freedom, everything he worked for. It's a classic cautionary tale, showing how even the smartest, most successful people can succumb to greed. You know, the desire for just a little bit more. It raises this question, right? When does enough become enough? And what are we truly risking when we chase more and more wealth? Housel argues that one of the hardest financial skills is getting the goalposts to stop moving. We achieve a certain level of wealth and then boom, we want more. We're constantly comparing ourselves to others, never feeling satisfied. He talks about this rookie baseball player making $500,000 a year, which, let's be honest, is a lot of money. But then he's playing alongside Mike Trout, who has a $430 million contract. Suddenly, the rookie feels broke, inadequate. It's all relative, right? And this constant social comparison, the insatiable desire for more, it can lead to risky behavior, ethical lapses, and ultimately, unhappiness. So where do we go from here? We've talked about the hidden forces that drive our financial choices, the role of luck, the dangers of chasing more. But is there a better way?
In the next part of our deep dive, we're going to explore some of Housel's insights on how to break free from these destructive patterns, how to create a healthier, more fulfilling relationship with money. All right, so we've seen how our psychology can really kind of mess with our money decisions, right? Yeah. It's not always about, crunching numbers and being a math whiz. It's about understanding our own quirks, our own biases. Now let's talk about one of the most powerful forces in finance. I think can make or break our financial futures. Time. And I'm not just talking about, having enough time to pay your bills or get to the bank before it closes. I'm talking about the magic of compounding, the way that money can grow exponentially over time. Housel, he illustrates this with a mind-blowing example, and it involves who else? Warren Buffett. We all know he's the investing juicy, right? But here's the crazy part. The vast majority of his wealth, we're talking billions upon billions of dollars, it was accumulated after his 50th birthday. Think about that for a second. This guy, who's already a legend, makes more money in his later years
than most people see in their entire lifetimes. Housel even crunched the numbers, and it shows that if Buffett had retired at 60, his net worth would be a fraction of what it is today. We're talking about a difference of 99.9%. That's the power of compounding, folks. It's not about hitting home runs every time. It's about, staying in the game, making consistent returns over a long period. It's like this analogy I heard about bamboo. You plant it, you water it, and for years you see nothing, no growth, no signs of life, just this little shoot sticking out of the ground. But then all of a sudden, boom, it shoots up like crazy, growing several feet in just a few weeks. That's what compounding is like. It takes time for those initial investments to take root, to build that foundation. But once they do, the growth can be explosive. The key takeaway here is patience, right? We live in this instant gratification world where we want everything now. But when it comes to building wealth, time is your greatest ally. Now, of course, compounding needs something to work with, right? And that brings us to another fundamental concept, saving.
Housel has this interesting take on saving. And it's not just about stuffing money under your mattress or opening up, high-yield savings account. He argues that saving is about creating a gap between what you have and what you want. It's about resisting the urge to, spend every dollar you earn, to keep up with the Joneses, to impress people you don't even like. It's about delaying gratification, making sacrifices today for a better tomorrow. And you know what? One of the most powerful ways to boost your savings, it's not actually to earn more, it's to raise your humility. Think about it. A lot of our spending is driven by ego, right? By wanting to project a certain image, to show off our supposed success. But what if we just, stop caring so much about what other people think? What if we focus on our own goals, our own values, and let go of that need for external validation? That's where true financial freedom comes from the ability to make choices that align with our own, inner compass. Saving is about more than just financial security. It's about buying back your time, having the flexibility to pursue your passions, to spend time with loved ones,
to explore the world, but to simply live life on your own terms. I remember this time, back when I was just starting out my career, I was working at this tech startup, long hours, lots of stress, but the potential upside was huge, stock options, the whole 9 yards. One day I was talking to this senior engineer, a guy who'd been through the whole startup roller coaster before. I was completely about the workload, the pressure, and he just smiled and said, the best thing about having some money saved up is that you don't have to put up with this crap. And that really stuck with me. It wasn't about being rich. It was about having options, about not being trapped in a situation that was, sucking the life out of me. So yeah, saving isn't just about accumulating money. It's about investing in your freedom, your future self, the ability to make choices that truly matter. All right, we've talked about time, we've talked about saving, but what about investing? How do we actually put our money to work and make it grow? Well, Housel has some interesting insights here.
And it starts with understanding the difference between being rational and being reasonable. We often hear that we should be, rational investors and make decisions based on logic, data, analysis. But Housel, he argues that when it comes to money, being pretty reasonable is often more effective than striving for, pure rationality. He uses this crazy example of a doctor in the early 1900s who treated syphilis, this, serious disease, by deliberately giving patients malaria. I know it sounds insane, right? But his reasoning was that high fevers, they could sometimes kill the syphilis bacteria. And guess what? It actually worked. He even won a Nobel Prize for his unconventional methods. Now, I'm not saying we should all go around injecting ourselves with malaria to get rich. The point is that sometimes the purely rational approach, the one that ignores our, human quirks and emotions, it isn't always the best, especially when it comes to something as personal and emotionally charged as money. We need to factor in our own psychology, right? Our fears, our hopes, our biases. We need to make decisions that we can actually stick with. Even when the market, throws a tantrum, Housel even suggests that we should, get this, love our investments. It might sound a little cheesy, but think about it. When you invest in something you're passionate about, a company you believe in, a cause you support, you're more likely to weather those inevitable market storms.
Yeah.
You're not just chasing returns. You're invested in something bigger than yourself.
Yeah.
And that can make all the difference, especially when things get tough. So yeah, embrace your emotions, your passions. It's not about being a robot. It's about making financial decisions that feel right in your gut, that align with your values, that you can live with for the long haul. Now, another thing to keep in mind is that historical data can be a misleading guide to the future. We often look at past market performance and assume that it will just repeat itself. But as Housel points out, things change. And sometimes they change dramatically. Think about how technology has transformed the financial landscape in just the past few decades. The rise of the internet, mobile banking, cryptocurrencies, it's a whole new world out there. The way we save, invest, and interact with money, it's constantly evolving. So blindly relying on historical data can be like trying to navigate a modern city using a map from the 1800s. Another important factor is that, different investors have different goals and time horizons. What might seem like a crazy valuation to someone focused on the short term could make perfect sense to someone with a longer term perspective. Take the dot-com bubble, for example. Yeah, those valuations were insane in hindsight. But for investors who were riding that wave of momentum, who were buying and selling quickly, it wasn't necessarily irrational. They were playing a different game, right? One with different rules and different risk profiles. The problem, of course, is when long-term investors get sucked into that short-term frenzy, ignoring valuations and fundamentals. That's when bubbles form, and that's when people get hurt. So it's crucial to, define the game you're playing, to understand your own goals and time horizon, and to avoid getting swept up in the hype or fear of the moment. All right, let's talk about something we all have to deal with in the world of money.
And that's the constant battle between pessimism and optimism. I remember back in 2008, during the financial crisis, things were looking pretty bleak, to say the least. The stock market was tanking, banks were failing, and everyone was freaking out. And I remember reading all these articles, these predictions of doom and gloom, the end of capitalism, the collapse of the dollar, the whole shebang. It was scary stuff. And you know what? Pessimism, it's seductive. Especially when it comes to money. It's we're wired to focus on the negative, right? The potential threats. Because, it's our survival instinct kicking in. But Housel, he makes some interesting points about why we should be wary of pessimism. For one, pessimists, they tend to, extrapolate current trends. Without considering how markets and people adapt, they see a problem and assume it's only going to get worse. Without acknowledging, our ability to innovate, to find solutions, to bounce back. Remember the peak oil hysteria back in the 2000s? Everyone was convinced we were running out of oil. Prices were skyrocketing. The world was going to end. But guess what? Human ingenuity, it kicked in. New drilling technologies like fracking emerged. Production soared, and the crisis was averted. It's a reminder that progress, it often happens in these unpredictable ways. We face a challenge, we innovate, we adapt. It's not always a smooth ride, but it's rarely that, doomsday scenario that pessimists predict. Another thing Housel points out is that progress often happens too slowly to notice. While setbacks, they tend to be sudden and dramatic. It's like the news. We hear about plane crashes, terrorist attacks, natural disasters. These events, they grab our attention because they're
like immediate and impactful, but the gradual improvements in our lives, the slow and steady progress that often goes unnoticed. Think about how much safer our cars have become, how much cleaner our air is, how much longer we're living. These are incredible achievements, but they happen, incrementally, so they don't make for dramatic headlines. It's important to recognize this bias, to appreciate the long-term progress, even as we acknowledge the inevitable bumps along the way. And here's a really powerful thought. Housel argues that the stories we tell ourselves about the economy, they can have a huge impact on our financial well-being. He paints this picture of an alien visiting Earth in 2007. Just before the financial crisis. The alien sees all this incredible technology, innovation, and progress. Then it, fast forwards to 2009. The alien is shocked to find that people are, trillions of dollars poorer, millions are unemployed, the stock market has crashed, the alien is baffled. Nothing has changed in terms of technology, resources, or, human potential. So what happened? The stories we told ourselves, they changed. In 2007, we believed in the stability of housing prices, the wisdom of financial markets, the ingenuity of our leaders. By 2009, those stories, they had crumbled. The narrative had shifted, and that shift in perception, that loss of confidence, it had a devastating impact on the real economy. It's a reminder that our beliefs, our narratives, they can have this powerful, self-fulfilling prophecy effect on our financial lives. So what stories are we telling ourselves today? What narratives are, shaping our financial decisions? Are we clinging to outdated beliefs? Are we letting fear or greed dictate our actions? These are important questions to consider because the stories we choose to believe, they can have a profound impact on our financial future. All right, we've covered a lot of ground here. We've talked about time saving, rationality versus reasonableness, pessimism versus optimism, and the power of, narratives. But there's one more concept I want to explore before we wrap things up, and it's all about building in a margin of safety. Creating that buffer that allows us to weather the inevitable storms of life. Life has a way of throwing those curveballs, right? Out of nowhere, bam, sudden car repair, a job loss, or who knows, maybe even another global pandemic that shuts down the whole world, right? It's tough to predict that kind of stuff. And that's where Housel's concept of room for error comes in. He gives this example of blackjack card counters, those guys who try to beat the casino using math. But even the best card counters, they know they can't win every hand. They have to account for, things not going their way, so they bet conservatively, even when the odds are in their favor, to make sure they can stay in the game long enough for their strategy to work. And it's the same with our finances, right? We make plans, set goals, invest carefully. But you can't predict every twist and turn life throws at you, right? Unexpected expenses pop up, markets crash, things change. That's why it's so important to have that margin of safety, a cushion to absorb those shocks, whether it's an emergency fund, extra cash on hand, or just avoiding that mountain of debt. This room for error might seem like you're playing it too safe, you're sacrificing potential gains. But it's actually what allows you to stay in the game for the long haul. Think about it, right? If you're forced to sell your investments at a loss, because let's say your roof suddenly needs replacing, you just wiped out years of potential growth. But if you have that cushion, that room for error, you can ride out the downturn and let your investments recover. Housel tells this story about Bill Gates. Back in the early days of Microsoft, Gates was obsessed with having enough cash on hand to cover years worth of payroll, even if they didn't sell a single product.
It seemed crazy at the time, way too cautious. But he gave him the flexibility to survive during those, uncertain startup years. And this room for error idea, it's not just for big companies or high rollers. It's for everyday folks like us, saving for retirement, factor in the possibility of lower than expected returns or, unexpected inflation, taking on debt. Make sure you can still handle those payments, even if, things get a little tight. It's about being realistic, not blindly optimistic, and building in that buffer zone to protect yourself from the unexpected. All right, one last point from Housel before we wrap things up. And it's a good one. He talks about the importance of, recognizing the game you're playing. He argues that, investors often make mistakes because they try to follow the lead of other investors who are playing a completely different game with completely different rules, right? Remember how we talked about different time horizons? Well, that's a perfect example, A day trader, someone who's focused on those quick profits. They might buy a stock based on, a hot tip or gut feeling.
They're not really concerned with the long-term prospects of the company, just riding that short-term wave. But a long-term investor, someone who's looking to build wealth over years or even decades, they probably see that same stock as a risky bet. They're looking for solid fundamentals, sustainable growth, not just a quick buck. The problem comes when these two types of investors start influencing each other, right?
The day trader might see a stock soaring and think, hey, everyone's buying it, must be a good investment. But they're forgetting that they're playing a different game, one with much higher risks. And a long-term investor might get caught up in the hype, buying into a fad just because it's popular, and they end up losing big. So it's crucial to define your own game, Figure out what your goals are, what your time horizon is, what your risk tolerance is, and stick to your plan. Don't let the actions of others, especially those playing a different game, sway your decisions. So there you have it, our deep dive into Morgan Housel's The Psychology of Money. It's a fascinating look at how our minds work,
How our emotions and experiences shape our financial decisions, sometimes for better, sometimes for worse. The key takeaway: it's not just about being the smartest investor or the one with the highest returns. It's about understanding yourself, your own unique psychology, and making financial choices that align with your values, your goals, and your vision of, a fulfilling life. Think long-term, embrace humility, build in that margin of safety, and most importantly, define your own game and play it with confidence and integrity. And hey, if you ever find yourself, tempted to chase those get-rich-quick schemes or make that impulsive purchase you'll regret later, just remember, the most valuable investment you can make is in understanding yourself. That's all for today's deep dive. Until next time, keep learning, keep exploring, and keep those financial goalposts in check.